This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So now that you are hopefully happy with the world of hedge accounting, let's just go through and look at some of the quirky bits on top that you need to have a knowledge of, which are looking at the hedge accounting criteria. So the rules that dictate when you can use hedge accounting and what you must do to ensure that hedge accounting is followed to the letter of the law. And also that hedge effectiveness, which we mentioned very, very briefly within our cash flow hedge video. Now we will start to look at it in a bit of detail. Okay, so what we've got there, this hedge accounting world, you've got to be careful from an accounting perspective, because what can happen is businesses can have various items that exist within the business, all these different purchases of assets, sales of inventory, different loans, and they can have several different hedging instruments that they just cherry pick which instrument matches up to which item. And the reason why they then chop and change and cherry pick is because it means that they are more effective with one instrument than with another. Okay, can't have that. What we've got to do is when we enter into the hedge itself, we need to make sure that we have the formal documentation for the hedged item. So what is the specific item we are hedging? We need to look at the hedge instrument and what that hedged instrument specifically is. So what is the specific future that is being used? And also the details of the risk, okay? Because in IFRS 7, we need to have some quantitative and qualitative disclosures of the risk that we are faced with. Okay, so it all needs to be documented, all needs to be designated so that we know what item is being protected by which specific instrument. Okay, we need to make sure that the instrument and the item are allowable for hedge accounting. So that's specifically looking at which scenarios we had under cash flow, which scenarios we had under fair value hedges, and making sure there as well that we have a specific, if you like, allowable derivative. Okay, in all scenarios, I'd have thought within P2 you will either be using futures or forwards, and therefore they are allowable instruments. The one at the bottom, I think, is probably the most important. It starts talking about effectiveness. Under the old standard, there used to be specific rules about the level of effectiveness and specific percentages about how effective a hedge had to be to do hedge accounting. That no longer exists under IFRS 9. We just need to see that there is some form of effectiveness, and that effectiveness is arising from form of X, or arising from some form of economic relationship between the two. So that if there is a change in the item, that change in the item, if you like, drives the change in the instrument, and vice versa. So there is an economic link between the two. Okay, if not, then you know the level of effectiveness could be skewed to factors away from the economic relationship. Okay, so when you're looking at hedging an interest rate, or you're using an interest rate swap to either protect the future cash flows on a variable rate loan, or to protect the fair value on a fixed rate loan, there is an economic relationship between them, isn't there? And any changes on the interest rate will impact the change in the future payments and will change the fair value of the loan. Okay. Another small point there as well is that the effective credit risk doesn't dominate the change in value. Okay. Because credit risk is very difficult to effectively go through and manage, isn't it? Okay, it's not so much within your control. Okay, we want to look at economic factors, interest rates, inflation, price risk that dominate the change in value. Okay, so just bear those in mind. I'd learn them and be able to regurgitate them within an exam in case you were asked to talk about them. Okay, should be pretty straightforward. However, what I want to focus on a little bit more is just looking at this hedge effectiveness. Okay, because what we saw in the cash flow hedge example is that it was perfectly effective, wasn't it? The gain on the instrument matched up entirely to the loss on the item, and vice versa. And however, we then moved on to the fair value hedge scenario, didn't we? And then there's a little bit of ineffectiveness, wasn't there? Okay. We had an overall, was it 0.02 million, I think, expense that ended up going through profit or loss. Okay. So what's all this about then? Okay, well, we need to look at the level of effectiveness. If the gain matches up entirely to the loss, then it's 100% effectiveness. But if the gain on the instrument is different to what you have on the loss, then there's an ineffective portion to it. But what we need to know is what's the effective element and what's the ineffective element. Okay, so this is where we go through there and look at over and under hedging. Okay, strap yourselves in. Okay, we'll talk our way through it. We'll then play around with some numbers, and that should make it easier to understand. What you've got an over hedge is whereby you're looking to protect the value of your item, but the instrument that you have used, the gain or the loss on that instrument, so the change in the value of the instrument is higher than the change in the value of the item. Okay, there's more of a gain or loss on the instrument than what there is on the item. You've over hedged. Okay, there's too much gain, there's too much loss than what is required to offset the gain or loss on the item. If that is the case, there is some form of ineffectiveness. Okay, you have too much of a gain or loss on the instrument. So it's only really relevant in a cash flow hedge, because in a cash flow hedge, the effective element goes through OCI, the ineffective element goes through profit or loss. Okay, so here what we have in an over hedge, the effective amount is always the lower of the two, the lower of the gain or the loss on the instrument and the item. So as the change in the instrument is higher than what happened on the item, we look at the lower gain or loss on the item, and that there will be the effective element that goes through OCI. The difference is the ineffective element, which then goes through to profit or loss. Okay. I told you it was hard. If there is an under hedge, then that means that the gain or loss on the instrument is lower than what you have on the item. Now remember, there's no accounting for the item, is there? Okay, so what we've got here is we need to account for the instrument. Now the instrument has got a gain or loss which is lower than the future gain or loss on the item. So we just need to go through there and say, well, look, there's no ineffectiveness. It's all right, it's not effective enough because it doesn't reach up here, but there's no ineffectiveness. It's not over hedged, is it? It's under hedged. So again, what we will do now is we'll go with the lower of the two figures, which is the gain or loss on the instrument, and that will go to OCI. We've taken all the gain or loss through OCI on the instrument. There's nothing extra to account for, is there? There's no ineffective element. Okay, so therefore nothing is taken to profit or loss. Yeah, pause the video, go back through it if you so wish before we go through then, and just have a look at the little illustration that we have here. Okay, so what have we got? Let's just throw in some numbers. What you've got up here is you can see that the hedged item has a $0.4 million loss, and the instrument has a $0.5 million gain. Who cares what the gain or losses arise from? Okay, some economic factor, whether that's interest, inflation, foreign exchange rates. But what you can see here is that the gain on the instrument is higher than the gain on the item. Remember, we need to account for the instrument, because remember, this is only relevant in cash flow hedging, so I'm not accounting for this loss on the item. So the gain that we have on the instrument, what are we going to do? Okay, well, we need to go through there and look at what is effective. Okay, and is it over or under hedged? Well, it's over hedged, isn't it? Because here's the loss at 0.4 million on the item. Here is the gain on the instrument. There's too much of a gain. Okay, it's over hedged. We need to account for the full 0.5 million gain, don't we? But of that 0.5 million, only 0.4 relates to the item. So that's the effective amount, isn't it? Okay, so there is ineffectiveness as we are over hedged. The 0.4 million, which is the lower of the two, goes to other comprehensive income, doesn't it? As that is the effective level. And then the ineffective portion, the 0.1 million, goes through profit or loss. Okay. Happy? Debits, credits. Well, we've got a gain on the instrument. So it's a financial asset, isn't it? So I debit the financial asset with the 0.5. The effective element with the credit goes to OCI at 0.4. And then the ineffective element at 0.1 goes through profit or loss, doesn't it? Yeah. The debits and credits for the item, really straightforward. There's nothing to do because we haven't gone through yet under the cash flow hedge and recognize the item until we enter into the transaction. Okay. Happy with that. Debit the financial asset with the 0.5. Credit OCI with the effective element of 0.4, the lower of the two figures, and then credit profit or loss. Yeah. So let's just flip it round. What happens there now if the gain on the instrument is lower than the loss on the item? Again, don't worry where the numbers come from. There they are, just up there. Okay. What you can see here is that here's the item and there's the loss. Here's the gain, which is less than the loss on the item, isn't it? So you have an under hedge. The change in the value of the instrument is less than the change in the item, isn't it? If that's the case, there isn't effectively any ineffective. Well, there is ineffectiveness because it's not 100% effective. But what you've got here is the lower of the figures is the 0.8, so that's the effective element, okay, which goes through OCI. So if you think about the debits and the credits, you debit the financial asset because we have a gain, and you credit OCI with the 0.8 million. Okay, because that's the effective element. There is ineffectiveness in the hedge, but there is no ineffective element to record, is there? Why? Because we have under hedged. We've accounted for the instrument, haven't we? Debit financial asset 0.8 million, credit OCI with 0.8 million. There's nothing ineffective, even though there is ineffectiveness in the hedge, because it's not 100% matched up, that goes to profit or loss. Okay, there you go. That's as hard as it will get. If you spend all your time working through this video and hours and hours and hours about hedging, you'll get a few marks if it crops up within the exam. Spread your knowledge across all areas of the exam. Okay, yes, this is tough. Yes, this is challenging. So it will need a little bit more time than some other areas. However, don't let it be the sole focus of all your revision. If you do, you will struggle. Okay, you need to have a broad coverage of all of the syllabus. Okay, so for the time being, that's it in terms of your hedging. I wish you the best of luck in studying and revising it. And if you've got any questions, you know where to find us on the Ask the Tutor forum. Enjoy.